So what knowledge do the elite investment managers have that helps them achieve above 20% annual returns on average? In this video, I'm going to share some of these secrets. The average investor only has access to traditional financial advisors. These guys overcharge nearly all of the time by putting people's money into over-diversified and underperforming index funds, which anyone can do themselves. Now, when you become a high net worth individual, you get access to the best investment management talent in the space. Instead of settling for the poor returns from traditional financial advisors, who at best can usually earn 12% returns on average, but that would be through a higher risk index fund, you get access to people who actually do the research to reduce risk and to outperform. Some of the best managers of all time include Anthony Bolton, who on average returned 20% a year, and one of my favorites, Paul Tudor Jones. He achieved 19% returns on average every year, and some years he even returned over 80%. And then there's Peter Lynch, who on average returned over 29% annual returns. So what is the one thing that they have that others don't? Well, in this video, I'm going to go over some of the principles that I've used myself to outperform the markets and quit my job 4 years ago to pursue investing full-time. And at the end of this video, I'll tell you the overarching principle required to outperform that's used by every single successful investor that isn't taught to financial advisors. So before I dive right in, I should introduce myself. My name is Daniel, and I have over a decade of experience in the investment world. I'm a chartered alternative investment analyst. I was an investment analyst at S&P Global. I hold a master's in finance, and I've also published papers on predicting asset prices that made a significant impact in the field. But most importantly, I spent all these years studying the best investors to ultimately develop my own tools to outperform markets. So let's dive in, and if you wait until the end of the video, I'll drop the underlying trick that every successful investment manager has up their sleeve to separate them from average. So the first principle I want to talk about is that the stock market is affected more by behavioral science than financial science. Now, hear me out. It's ultimately humans that decide whether an investment gets made or not. And this results in things such as psychological biases, the fear of missing out, and greed, contributing to price movements. Now, company financials and news do obviously play an important role in a company's valuation. However, it is humans in the end that decide whether an asset is bought or sold. Therefore, human emotions and psychological biases are embedded into the price of assets. And this is important to be aware of because asset prices can sometimes go multiples higher in terms of price before it ever returns to the value placed on it by financial analysts. So really what you should take from this principle is that it's not just financial analysis that matters in the analysis of stocks. There's so many different parts of the puzzle that you need to put together to actually successfully value a company. Just because a financial analyst at a bank like JP Morgan or Goldman Sachs says, okay, the discounted cash flow valuation is, let's say, $57. That doesn't capture things like human emotions, or let's say if it's a tech company, it's very difficult to value things like exponential growth or network effects. These are things that add so much more value, but they can't be captured explicitly with these models that financial analysts use. And there's a bit of an edge in knowing that. If you know this, and you can take into account these other parts of the pie that contribute to an asset's actual valuation, you can make a profit on the mismatch of valuation. I'm going to make another video on this topic specifically because it really is an important game changer for anybody who's investing or wants to grow their wealth. So the second important principle in this video is that evolution also affects the stock market. Very similar to evolution in nature in all aspects of the world, evolution affects the stock market. This primarily happens when a profitable investment idea is found by the masses. As more investors pile in to this investment strategy, less profit is available from it, and extra normal returns eventually dissipate. Even Warren Buffett himself has lost his edge to natural market evolution. His strategy was very profitable in the 80s and 90s. Essentially what he was doing was financial statement analysis. He was analysing the book value of a company and comparing it to the price indicated on the exchange. And that's essentially the whole point of value investing. You're trying to find an investment that's undervalued. That worked insanely well for Warren Buffett, but because of evolution, everybody was studying him and what he was doing and started to apply it themselves. So many hedge funds back then were doing the same thing, and lots of people made plenty of money from this strategy. So most finance courses will teach how to value a company, financial statement analysis, and now everybody does it. And so if everybody's doing it, and I'm talking about institutional investors and high net worth individuals, if they're all doing this, then what's the piece of information that someone else has that another person doesn't that gives them that edge to outperform? Because everyone is doing the same analysis, there is no extra normal return you can achieve from doing the exact same thing that everybody else is doing. So essentially it's evolution, and because of this evolution, this value investing traditional strategy just doesn't work anymore because everybody's applying the same analysis. But those aware of market evolution can outperform consistently. Because if you come up with a strategy and it works, eventually other people will find it, and the returns you get from the strategy you're using will eventually decline. But by knowing market evolution, the concept of it, you're always going to be looking to either improve the strategy you have or look for that other edge. When investing, you always need to be willing to change your beliefs and analyze the market for exactly what it is, rather than sticking to the old rules that used to work. So remember, it's only those that actually are aware of market evolution that can outperform markets consistently for more than 10 years. So the next topic I'm going to talk about is hugely important, but it's widely misunderstood, especially in the investment community. So a topic is diversification. Diversification is the most misunderstood concept in investing. Diversification is key, they say. So we diversify more and more. However, after a certain point, too much diversification mathematically removes the possibility of outperformance while not even affecting risk. So essentially, your risk is the same and you're just reducing the amount of returns you can get. It doesn't make sense. An investment portfolio that efficiently minimizes risk and still allows for price appreciation should have a maximum of 15 to 20 uncorrelated assets. I won't go into the maths of it in this video because I'm just trying to give the overall concepts that are really important to know. I will make another video on this concept in more detail in the future. But anyways, if you hold more assets in a portfolio than, let's say, 20, you end up diluting the upside potential of your best performing assets without reducing your risk. If you'd like to learn more about this concept of diversification and avoiding over-diversification, one of the greatest investment managers of all time, Ray Dalio, explains it perfectly. There's a video that he released on YouTube called The Holy Grail of Investing. If you'd like to find it, I put the link in the description for your convenience. The final concept I'm going to talk about in terms of investing secrets that will allow you to outperform is the concept of leveraging asymmetric bets to be able to let you achieve higher returns, but while limiting the risk. So the idea is simple. You want to find investments where the potential reward is much higher than the potential risk. Making large returns isn't about taking lots of bets or taking lots of risks. It's about making the right bets where you can lose a little if things go wrong, but win big if it goes right. So here are some examples on how best to do it. First, we can think about making small bets with massive upside. So think of it like buying a lottery ticket, except the odds are actually in your favor, if you know what you're doing. Top investors often use strategies where they can risk just a small amount of money for the chance to make a lot. So an example would be Paul Tudor Jones in 1987. He placed a smart yet controlled bet that the stock market would crash using advanced financial instruments called options. When it did crash, his fund returned a massive 125% that year. Now, if the market went the other way and it went up and the crash didn't happen, he actually wouldn't have lost the same amount of money. He would have only lost a controlled amount, which would be the amount he paid for the option contract. So the key here, like I said, is to make small, smart bets that don't hurt too much if they go wrong, but can make a massive difference if they go right. Now, the second example I can teach you about finding asymmetric opportunities is the concept of buying bargains in bad times, or distressed investing. This is about buying valuable things when they're unpopular and cheap. For example, David Tepper did this in the financial crisis of 2008. When everyone else was panicking and selling assets, he bought up bank stocks at rock bottom prices. When the market recovered, those investments skyrocketed and he got an annual return of 130% that year. Now, the downside was somewhat limited because he bought so cheaply when nobody else was buying, but the upside was so huge when things turned around. Now, distressed investing is typically reserved for investors who know a lot about analysing a company's financials, because you need to know that the company won't actually go bankrupt. But you can apply this knowledge to, let's say, the average recession, where you know a company isn't going to go bankrupt. For example, a recession can happen and really strong companies, their stock price will go down. You probably heard the concept buy the dip. In a sense, It's not distressed investing, but if there's nothing truly wrong with the company, it's a great time to buy. Third example of using the concept of creating asymmetric bets is to find an information advantage. Everyone knows insider trading is illegal, but what if you can find information that everybody has access to, but don't have the creativity or ability to find it? I took advantage of this concept in 2017. I created a program that scraped thousands of comments from a cryptocurrency forum, and I could analyze each comment in terms of whether the person posting was saying something positive or negative about the specific asset or cryptocurrency. I discovered a correlation. So the program would take all the comments made on a given day and decide whether on that day were the comments in total more positive or more negative. And the correlation that I found was that if the comments on a given day were mostly positive, it would result in an increase in the price the following day, which makes sense. Retail or average investors would be logging onto these forums, reading the comments over the last 24 hours, and they would make their mind up. If the comments were positive, they would jump on the bandwagon because they're not professional investors. They're reading what other people are thinking and getting the fear of missing out and feeling greed, and they're feeling these psychological biases that I was talking earlier in the video. And so they would make their investment decisions based on this forum. And this discovery that I made also worked inversely. If the comments was a net negative on the given day, where people were mostly saying bad things, the people that were looking at the forum were selling and the price would go down the following day. So it was a really interesting information edge that I found. It was one of my very first successful discoveries of a market edge, and I ultimately published a highly cited and academically significant paper on this discovery. This discovery netted me 2,000% annual returns in 2017. If you'd like to learn more about what I did, I'm going to put a link in the description to the original paper published by the Capco Institute of this discovery that I made, if you'd like to read it. So, why do asymmetric bets work so well? The reason why asymmetric bets are so powerful is this. They let you lose small but win big. Most people think investing is about playing it safe and spreading your money around as much as you can. But the best investors know it's about making calculated bets, where the upside is much greater than the downside. That even if a few investments go wrong, the winners more than make up for it. This is how the top investment managers turn small opportunities into outsized gains without exposing themselves to massive risk. They're not playing the same game as traditional financial advisors who are happy with a 4% annual return and then they call it a day. They're playing a game where the goal is to find those one or two bets that can double or triple your money, or even more, while keeping the risk small. Okay, so you made it to the end of the video. So here's the underlying trick that every successful wealth manager has up their sleeve to separate them from average. There is an overarching theme to successfully outperform the market. It's about finding an edge and not following the crowd. An edge being a piece of information or knowledge that you can assimilate, but others can't. It's about thinking outside of the box and seeing what others can't see. It's the same principle that was used in the film 21, which is a true story where a group of MIT students and their professor created an edge by using mathematics, where they would tip their win percentage in the casino, playing blackjack, to 51%, therefore statistically guaranteeing outperformance against the casino in the long run. This is a very similar concept to how the hedge fund investor Jim Simmons was able to consistently achieve over 66% annual returns with his fund, which is called Medallion. That is how the best hedge funds operate. So, if you are a high net worth individual looking for an investment manager, you should be looking for someone who has demonstrated an edge and not someone who says they analyze financials to find a good undervalued company to buy. First of all, there's no edge in that. And second of all, that's the standard work that every investment manager should be doing anyways. So you need to find someone who does that and applies their own strategy for discovering outperformance potential. So if you've learned something from this video, subscribe to the channel to keep learning more. And if you're a high net worth individual or an entrepreneur interested in building an investment portfolio focused on achieving asymmetric investment opportunities and leveraging my own experience, click the link in the description or visit senecaprivate.com/apply. See you in the next video.